Hi, this is a short PowerPoint on option trading, as a lot of my friends have asked me to explain how I am making income through option trading, and some of the figures are substantial. So I'll give you a brief outline of how option trading is done and what I learned in the last 4 months, which has helped me make substantial profits. So let's go to the first slide and I'll give you in a simple way what are options. Now, options are instruments called the derivatives. They are derived from an asset. Now, there are two kind of options. One is called the call option. The other is the put option. Now, call option is a right, but not an obligation to buy from a seller at a predetermined price called the strike price on an expiry date. This is an obligation. That means when you buy a call option, you are paying somebody a fixed amount to get the right to buy from him on a particular date. Now, put is just the opposite. This is the right to sell to a person an asset at a predetermined price called the strike price on the expiry date. Now, strike price is the price at which you agree to either buy or sell. It's called the strike price. And we'll go into detail. Expiry date is every option has an expiry date. It could be 1 week, 1 month, 2 months, 1 year, like that. Now, the question is, when do you buy a call or a put option? Now, usually when you study the markets, you know on a particular day the market has crashed. Now the chances are next day the market will rise, unless there is a news about the economy. But usually in the morning during the pre-market, there is an indication as whether the indexes are Sensex or Bank Nifty or Nifty is going up or down. Now, call options always goes up when the asset value moves up, and call options fall when the value of the asset drops. For example, Bank Nifty, if it is 30,000 at the start and suddenly it goes to 30,500, now the call options will be going up in value. And if it goes below 30,000, the call option will drop in value. The puts are exactly opposite. If the Bank Nifty opens at 30,000 and it goes down to 29,500, put options will start rising in value. And as they keep falling, the put options keep on going up in value. And the opposite happens when the Nifty direction price rise goes up. So the put option prices will be going down. Now, why Bank Nifty? I have, from my 3 months of experience, made the maximum amount of money by trading in Bank Nifty. Now, these are an index of some major banks in India, and they fluctuate a lot. I'll show you. Now, they are very volatile. They move fast, and they offer the opportunity to make also the money fast. Now, one lot of Bank Nifty is 25 is the multiplier. That means when you buy 100 rupee option, you pay 25 into 100, 2,500. Or if you buy an option of 200 rupees, one lot is 5,000. So you multiply whatever the price of the option by 25 for one lot. Now, how money is made? Now, suppose you buy one lot of all options for rupees 5,000. If the market goes up, this lot is rising, and you will see that the value of your options go up from 5,000 to 6,000, 7,000, 8,000. Suppose you sell it at rupees 10,000, you have made a profit of 5,000. It's as simple as that. And if you buy 10 lots, you are investing 50,000 rupees because you're buying more than one lot. This is my strategy. I typically go with 25 lots or 50 lots like that. So 50,000, and if it goes up, you sell it, you make a profit of 50,000 because you bought 10 lots. So bigger the lots, bigger the profit, and also could also be bigger the loss. Now, this is the movement of Bank Nifty. I'm not sure whether it is very clear, but you can go to the website and have a look at moneycontrol.com. Now, the Bank Nifty on January closed at 37,689. It had gone down by 292 points. That means it started and then fell 292 points. So obviously, if somebody had bought put options here, because it fell down, end of the day, he would have made a big profit. If you had call options here, you would have had a loss. So always there are opportunities during the day when it keeps moving up and down, up and down. When there is a major decline, that's where the maximum money is made or lost. So one strategy which I have been doing is, if the share is rising, I just watch what its highest point is. Now, instead of buying, I sell at that price, the option. And when I sell the option, I receive money from the buyer. So it's a credit for me. Now, let's say I sold the option when it was 1,000 rupees. Now I notice that the option price is decreasing. It comes down to 800 rupees. At that point, I have to square up, because if I've sold 100 options, I have to buy 100 options. So short selling is you sell first and then you buy to square up at a lower price, and that difference is your profit. Usually people buy low, but they don't know at what point to sell because it's going up. So I typically do the opposite. I see the trend, and if it is gone to a particular point and it's coming down, I sell and then wait for it to come down before I buy. So I am sure you'll have questions. You can send me an email. My advice is go to the Google and put options trading or option all option, put option, and you'll find a wealth of data. But decide on Bank Nifty, and this is the best way, in my opinion. You can make a decent amount of income every day, which is what my experience has been. So thanks a lot. Take care.